Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. It's the new package for this month. New package, I'm saying simply because of the Candlestick Formations webinars that we've been doing so far are a bit different. So basically, the sessions we've held before were pretty basic. The formations we've presented are down to the very easiest as possible. Therefore, we've actually managed to put it together in one simple webinar. However, the complexity of this month, and of course the webinars that we're presenting to you will be accompanied with a lot more different, in addition, candlestick formations, as well as we will be talking about chart patterns, more chart patterns in addition to those that we've been talking before in our basic webinars. So you can consider it as pretty much something like intermediate type of webinars. They're not so advanced as we've done so far for the past 6 months, but they're not very basic as well. Simply put, whatever questions you might have according to those formations, as well as anyone know easily that you can pretty much find information about these particular formations and patterns all in the web. Still, the best thing about these sessions is that questions that you might have directly about those formations. Why are they so important? What exactly makes them confirm? So on and so forth. Those type of questions will be answered directly after you've posted them into the chat, or if you wish to say something, you can always raise a hand and I'll just give you the microphone. Depending on the session, of course, if someone has something to show, like a drawing or an illustration about his experience, he's also welcome to do so. An observation of something new, repeatable on the chart that it's not been, spotted before. Let's put it this way, because new formations, they can appear every day. If you spot 4 or 5 different candlestick in a package, and after that you see something that it's happening and it's repeating over time, years after years, throughout your experience, you can always share that. It will be very helpful to everyone. Simply, we cannot just go through the formations without sharing a bit of a history or the most simple candlesticks that we will take a look at today in today's webinar, because they're actually the piece of the puzzle that forms the more complex formations, and after that more complex patterns. When we go through all of the webinars about the candlesticks and go through the chart patterns, from there you will see the patterns that I'm talking about, how significant they usually are. Talking about significance, I should also mention that particular candlestick formations and chart patterns are usually working well, let's say, without interference, when we have lack of any fundamental news, or at least any significant fundamental news that can change volatility from medium to high. Simply, why is pretty much because basically you've already experienced that in nowadays fundamentals play larger role into trading. And talking of which, leads us to believe that whatever patterns we spot on the market, especially on short-term time frames for daily traders, for example, it's extremely important to know that those formations will not hold ground. So even if you have a confirmed pattern, a formation of some sort, you decide to trade, but for some reason it gets invalidated or just goes in the opposite direction after confirmation. It's better to check the calendar if you haven't done so far to see if there is anything that came through in the past several minutes or hours, depending on the time frame, for you to know if that might be the cause for such invalidation. You see, the power of government officials and their announcements. We've mentioned this so many times, but still, every day I see new traders coming into those webinars. So most of the time I'm repeating myself, you know, as well as I've been repeating many times about the last 2 months of the webinars when we developed our trading plan. What is the basic structure? You can always sneak in those formations and use them when you have sluggish market, let's say, lack of fundamentals, and you're trading on smaller time frames, where of course those particular formations and patterns are much more powerful than any price action. So the first thing we have to mention about candlestick charts in general is that it is believed that they've been developed somewhere around 18th century. So you see, the development is, you know, who actually developed it is yet to be discovered. However, there are a lot of speculations between different people back in Japan, whether it's been a rise trader or just someone else that's been selling any other goods to measure price difference and to try to predict future price movement. It's not something that it's new to us. It's been used centuries ago. However, candlestick charts were introduced to the Western world later into the book of Mr. Steve Nyssen, also called Japanese Candlesticks and Charting Techniques. Various of charts, ladies and gentlemen, you can use to predict future price movement, such as bar chart, line chart, of course. Simply put, candlestick charting is by far the best charting technique that you can use for a very simple reason, because you have more information presented to you by individual candlestick line instead of a bar or just a line graph. Candlesticks are usually composed of a real body, which of course can be in a different color depending on how you prefer to see it on your charts, whether it's black or white or any other different color for bullish or bearish candles, and of course upper and lower shadows. Now those shadows, I might call them shadows, my colleagues might call them shadows, somewhere else you might find that those price swings also are called shadows, but many other traders are called them whips or wicks or price swings, whatever that you want to call them. It's one and the same thing. It's actually the price projection where it went from the lowest to the highest point in the session duration, with of course presented by the real body confined between the opening and the closing of the price. In this case, you see the opening, which is above the closing of the price. This represents a bearish candlestick. The information and the significance of one candlestick gives us enough information for us to decide and predict what the price will future do. It's very simple. The larger the real body, which one more time is confined between the opening and the closing of the price, that real body, the bigger it is, the bigger chance you have of a continuation in a few sessions in the same direction. However, Along with that, you have to have the smallest or no shadows at all, up and below. The larger the shadow it is, the less chance you get for a continuation in the near term. So using one candlestick to predict future price movement, we can do on 4-hour charts, daily charts, weekly charts, and something larger for day traders to use, which are actually used to use more than one candlesticks. Why I'm saying that? Shorter time frames need better confirmation, more powerful candlesticks, like confined between 2 or 3 or even 4 and 5 different individual candles to give you more clarity on future price movement. One candlestick, however, is absolutely enough on a daily chart to tell you what the price will do tomorrow. For example, I can give you the gold chart. If you switch on daily chart, you will see a lot of small candlesticks which pretty much look something like this. This is the Doji, also a candlestick line. However, in this case, it does not need to have a real body confined between opening and closing of a price, basically because the open and the close is at one price. The price swings, however, or the shadows below and above this open and closing afterwards, gives you the identity of the particular doji that you're looking at. And there are 4 majors. You can see the neutral doji, the long-legged doji, which are pretty much one and the same. However, the long-legged doji is relatively longer in price swing, let's say larger than 20-30 pips in size. The neutral doji is just a few pips, so 1, 2, 3 pips, not more than 5 pips in difference. So also the gravestone and the dragonfly are pretty much one and the same, with a slight difference of the, of course, the price swings, whether it's above or below this open-close price. Now, all of those 4 individual candlestick lines are extremely important for any chartist. Why is that? Because it signifies indecision between bulls and bears. So basically, this is some kind of a draw, if you want to take it as a fight between the bulls and the bears, you see. So basically, market indecision brings a lot of attention, especially on larger time frames. As we see on gold chart, for example, for the past 3-4 days, we've seen a lot of dojis. The price swings above and below, but always closing a flat line, pretty much. So any day, we will be able to see some large moves above, to the upside or to the downside. Of course, along with that, you can use additional candlestick lines to identify different patterns to give you a better price direction. That, of course, we will take a look at later today throughout the session. First of all, I would like to turn my attention to the last 2 dojis here. First of all, I would like to apologize for those that already know this part of the webinar or any of these, but please be patient. We will get to the more significant part where there are those which we actually haven't spoken of so far. So the gravestone and the dragonfly are one and the same. However, the gravestone is usually one that appears on the top of an uptrend. For example, when it appears on the top of an uptrend, ladies and gentlemen, then we can see a lot of downside movement larger than 50% from the recent uptrend. So this is a major reversal signal. The dragonfly is the same. If you see it on the bottom of a downtrend, it's a bullish reversal signal. Pretty much those 2 are one and the same, but simply the opposite. Also, let me continue by saying that if you also spot a gravestone on the bottom of a downtrend, this signifies a continuation of this particular trend after a slight sideways direction. So you can see how the price have opened here, swung quickly in a large number of pips to the upside, but didn't sustain that for any reason. And then, of course, closed at pretty much the same level it actually opened, when we can expect further downside. This one also, the dragonfly, also stands for the uptrend. When you see it on the top of an uptrend, you can also expect sideways to bullish continuation in the near term. Also about the Doji is very, very important, guys, for you to remember that when you're looking at a chart, it really depends on how far you've zoomed it in or out. So sometimes those dojis can look like a candlestick, for example, that it's defined as a hammer or a hanging man. Basically, you can see it reversed, let's say upside down to these figures. It's pretty much one and the same. Sometimes people call them shooting stars if you have a large shadow. What I'm trying to say is that if you've zoomed in your chart so much down at the end, you might be able to see something like this, for example, or like this. But if it's zoomed out by far, is what you need to see as a significance, which is represented as that particular doji, which you can see 4 of them over here. Those are the most important. Of course, we don't live in a perfect world where everything is symmetrical. Of course, that would mean that the shadows or the price swings above and below these opening and closing of the price can be relatively smaller here and larger on the upside, for example, or vice versa, smaller on the upside and larger to the outside, and still pretty much the same neutral doji or long-legged doji. The gravestone and the dragonfly, however, they require no shadows below or above each of those to appear. Very rarely, however, you will see a flat line with no shadows above and below. This is extremely rare sight. Pretty much presents a neutral doji. It's one and the same. It's quite possible to see this in some brokers, for example, that don't have a Sunday candlestick, for example. Some of those you might inquire, see, for example, sometimes just a flat line, because there was just where exactly the new session opened, closed, and opened a new one. So it depends on what's the time frame, what broker you use, how far you've zoomed in or out your chart, how those particular candlesticks appear. By far, one-click zoom in is perfectly enough for you to spot those formations, which we will further discuss. But first, I would like to turn my attention to the hammer here for you to see, because the hammer actually, or the hanging man, those are pretty much one and the same. I've just written it here as a hammer. Those here are the hanging man formations. However, they're pretty much one and the same, as you can see, with a very slight difference that in the hanging man you basically don't have an upper shadow at all. But in some cases, hammers are also formations with no shadows on the upper side. Hanging man, however, is the candlestick, the hammer actually, that you see on the top of an uptrend. Now let's see why this is an important bottoming candlestick line. Speaking of the hammer, which is one on the top here. The hammer, of course, as we mentioned, and the hanging man are both one and the same candlestick lines. Small in real body, black or white in the case, bullish or bearish, with no significance whatsoever, which of course appears on the bottom of the session's range, and of course a very long lower shadow. The hanging man, however, is also called the hammer, but it appears on the top of an uptrend. So it resembles a head and a human body, for example. If you just indulge me here with a bit of imagination, it could resemble to you as a hanging man on the top of an uptrend or on top of a tree. Whichever the case is, both candlesticks lines are one and the same, and you can still summarize them as a hammer. One of it, of course, is bullish, the other one is bearish hammer, regardless of their colors. If you see a white real body hammer on the top, that's a bearish, and vice versa. If you see a black real body hammer on the bottom of a downtrend, it's a bullish reversal signal. Of course, the very important here is the significance between the difference between the real body size and the size of the shadow. For a classic hammer, for example, the shadow, of course, should be at least 2 times the size of the real body, meaning about the size, that's the height. So if you measure it in pip size, and let's say between opening and closing here, we have 20 pips, that means 2 times 20, that means 40 from the opening of the candlestick down to the extremum of this particular candlestick line. It should be at least 40 pips, not smaller, to call it a classic hammer. As I mentioned, we don't live in a perfect world, so you can expect hammers to occur with less than 2 times the size, let's say with just a few pips, up to a 5 pips size, smaller than the necessary classic hammer, which is 2-to-1. Also, speaking about the hanging man in particular, it is usually followed by a very quick price move on the following session. So if you're looking at a let's say daily chart here or an hourly chart, the next candlestick that will open will usually open with a slight let's say slight gap between the opening here or the closing and the opening of the next session. So gap between the closing and the opening of the next session, it usually occurs in the large percentage of cases. If you just scroll the charts, find these formations, those candlestick lines, you will see that in most cases, especially on the smaller time frames, shadows occur, gaps occur right after a hammer is constructed on your graphs. Now, in the principle of hanging man, however, the shadow below should be at least 3 times the size of the real body. So this is the only difference between the classic hammer and the hanging man. For a classic hammer to occur, the only thing you need is at least 2 times the size of the shadow compared to the real body. But for a hanging man, which is of course on the top of a on top of an uptrend, to be as powerful as we're speaking about, the shadow should be at least 3 times the size of the real body. And as you can see, that is the reason why you see those 4 pairs, those 2 pairs or 4 candlesticks here have relatively larger shadows than those 2 pairs above here. Now, Most of you know that, as I mentioned also earlier today, is that the more candlesticks we add to our patterns, the more significant they will be. So basically, using an additional candlestick line, we will take a look at a few piercing patterns. 3 piercing patterns in front of you, ladies and gentlemen, which are extremely important, especially when they occur on the top or in the bottom of a trend. Why we have a dark cloud cover and engulfing patterns? You can see that all of these are relative to the piercing patterns because they usually pierce half of the previous session. Now individually we will take a look at all of these. The first 2 pairs bullish piercing patterns occur usually at the bottom of a downtrend, which of course signals bottom reversal or bullish. In a downtrend, as we mentioned, a long black candlestick is followed by a gap. As you can see, the opening and the closing here, the closing of this candlestick with the opening of the next session occurs after a gap. And after, of course, this session finishes with a strong white or bullish candlestick, which definitely pierces half of the previous session real body and closes above it. This you can call a piercing pattern. Of course, the gap here that you see in the second pair is not present for a very simple reason, that it depends on how volatile the unit that you're trading is. So in more volatile trading units like the euro dollar or the GBP versus the USD or anything else that is relatively more preferred among traders, you can see gaps on smaller time frames. And this particular red line, from now on we will call it a neckline. You will see the same particular neckline to occur in our chart formations in the future in our sessions. The dark cloud cover, however, this is a bearish reversal signal and usually occurs on the top of an uptrend. You see, the relevance between those two are the pretty much that one of it is a bearish reversal, the other one is a bullish reversal, but the structure of those 2 particular piercing patterns are one and the same. Those 2 cases are called directly piercing patterns. The dark cloud cover is also a piercing pattern because it pierces the neckline of the previous session. And of course, it usually occurs again with a gap after the closing and the opening of the new session, followed by a strong bearish candlestick piercing the half of the previous session and closing below that particular neckline will signal to you a bearish reversal. Also, the one on the right side is without any gap. This is for the cases of less volatile units where gaps are rarely occurring on your charts, or you're looking at a larger time frame such as daily chart or weekly or a monthly chart, where of course gaps usually virtually don't occur. Both of those are bearish reversal signals, which are very, very powerful, especially on a smaller time frames. Engulfing pattern, why is it called an engulfing pattern? Is very important for you to see here. that there is a bearish and bullish engulfing pattern, but it still resides in the section of piercing patterns. You see, a bullish engulfing pattern, for example, is comprised of a large white real body candlestick which engulfs a smaller black real body in a downtrend. So this, on the left side engulfing pattern, the white candlestick not only pierces half of this previous session, but it actually closes way above the opening of the previous session, which makes it totally engulfing because it surrounds the whole real body of the previous session. The one on the right side, ladies and gentlemen, is pretty much the same as the one on the left, with the difference that it's a bearish reversal and it occurs on the top of an uptrend. And one more time, it pierces the neckline, half of the previous session, and closes way below the previous opening of this white candlestick. The significance of those two also play a large role on daily charts, as well as my experience a long time, especially on the engulfing patterns. And an engulfing pattern also can occur without a gap. So in the cases when you're trading larger time frames, those engulfing patterns also occur as an engulfing pattern. However, the opening and the closing of the sessions are aligned and pretty much at one price, but still the following session engulfs the full real body of the previous session as well. So in those cases, which you can use those piercing patterns, ladies and gentlemen, you can also see no gaps, and of course virtually very small engulfing in pip size, like 2-3 pips, for example. If you zoom in enough for you to see that, in a far zoom out, it will probably look like one and the same session, one next to another. Let's say you had an uptrend, your session, the last session that you've been observing ended with a bullish candle. The next one is a bearish candle, relatively the same size. This is also an engulfing pattern. So as I mentioned earlier, we don't live in a perfect world, so you cannot expect the patterns that you see as an illustration in front of you to be as perfect as they are right now, as symmetrical as they are. Simply, a trained eye can see all of this without a question, and the future experience will give you exactly this, and you will use them accordingly. This is pretty much the end of today's session. We will continue next time with more candlestick formations, and of course we will talk about star formations. We will have a look at different haramis, and of course more will follow. We have 3 individual webinars which will be only for candlestick formations. There will be more than 10 individuals, and of course 3 separate sessions we will have for chart formations or chart patterns, depending on how you like to call it, where of course we will see how a whole bunch of candlesticks could be more powerful than even 3 or 4 individual. Until next time, don't forget to sign in if you haven't done that already. I'll see you. Thank you very much for joining us. See you next time. Bye-bye.